company that sucks CO2 from the air just got valued at over $1 billion. They haven't removed enough carbon to offset a single day of New York City's emissions, and investors are fighting to give them more money. In Silicon Valley right now, there's a new gold rush happening. But instead of searching for gold or building social media apps, investors are pouring billions into climate tech startups. Companies that promise to pull carbon from the air, convert CO2 into fuel, grow meat in labs, engineer better batteries, build nuclear reactors the size of shipping containers. Some of these companies have real technology that could genuinely help address climate change. Others are selling hype and vape, but it doesn't matter. The money is flowing like water. Venture capitalists who made fortunes from tech are now betting on climate. Bill Gates has committed over $2 billion to climate startups through breakthrough energy ventures. Jeff Bezos put $10 billion into the Bezos Earth Fund. Hundreds of other billionaires and investment funds are following suit. They're not doing this primarily out of altruism. They see an opportunity. Climate change represents a multi-trillion-dollar market transformation. Every industry has to change. Energy, transportation, agriculture, manufacturing, construction. All of it needs to be reinvented for a zero-carbon world, and whoever builds the technologies for that new world is going to get obscenely rich. This is creating a boom unlike anything we've seen since the dot-com era. Climate startups are getting funded at incredible valuations with minimal revenue. Founders in their 20s are becoming overnight millionaires. Early investors are making 100-fold returns. And just like the dot-com boom, some of these companies will succeed spectacularly, but most will fail. Billions of dollars will be lost. Promises won't be kept. Technologies won't work at scale. And along the way, there's going to be fraud, hype, and disappointed expectations. By the end of this video, you're going to understand what's really happening in climate tech, which technologies actually have potential, which ones are just smoke and mirrors, who's making money, who's getting scammed, and what this gold rush means for actually solving climate change. Because this isn't just about technology or money. It is about whether we're rebuilding real solutions or just creating another bubble that benefits investors while the planet keeps burning. Let me start with the numbers that are driving this frenzy. Global investment in climate tech reached over $70 billion in 2023. That is up from about $16 billion in 2019. A more than four-fold increase in just 4 years. And projections suggest it could reach $200 billion annually by 2030. This money is flooding into every conceivable climate-related sector. Carbon capture, alternative proteins, sustainable aviation fuel, battery technology, grid storage, nuclear fusion, electric vehicle infrastructure, green hydrogen, vertical farming. The list goes on. And within each sector, there are dozens or hundreds of startups, all competing for funding and market share. The returns are what's attracting investors. Some early climate tech investments have paid off spectacularly. Tesla is the obvious example. Early investors who believed in electric vehicles when everyone else was skeptical made absolutely massive returns. $1,000 invested in Tesla at its IPO in 2010 would be worth over $100,000 today. That's a 100-fold return. It's why so many investors are piling into climate tech, even though the risks are high. Let's talk about some specific categories and companies to understand what's actually happening. Carbon capture is getting enormous amounts of funding. The idea is to pull CO2 directly from the atmosphere and either store it underground or convert it into useful products. There's a company called Climeworks that's built facilities in Iceland that suck CO2 from the air. They're using renewable energy to power fans that pull air through filters. The CO2 is captured and then injected deep underground where it mineralizes into rock. It's real technology that works, but the scale is tiny. Their largest facility captures about 4,000 tons of CO2 per year. Humanity emits about 40 billion tons per year, so this one facility offsets about 0.00001% of annual emissions, barely a rounding error. Yet Climeworks has raised over $600 million and is valued at over $1 billion. Why? Because investors believe the technology will scale, that costs will come down, that eventually these facilities will be able to capture millions or billions of tons of CO2 per year. Maybe. But there are huge technical and economic challenges. Carbon capture is energy intensive. Each ton of CO2 captured costs several $100s currently. For this to be viable at scale, costs need to drop below $100 per ton. Many experts think that's achievable, but it requires massive technological improvement and scaling, and it's not guaranteed to happen. There are competitors too. Carbon Engineering, backed by Bill Gates, is developing similar technology. Global Thermostat is another player. Carbfix in Iceland is working on mineralization technology. All of them are raising money and making ambitious promises. Some will succeed, others will fail, but investors are betting on the sector overall, hoping that at least one or two become massive companies. Then there's carbon utilization. Instead of just storing CO2, can you convert it into something useful? Companies like LanzaTech are capturing CO2 from industrial facilities and using bacteria to convert it into chemicals and fuels. 12 is making products like sunglasses and airplane parts from captured carbon. These approaches are appealing because they create revenue, not just capture carbon. If you can make a valuable product from CO2, the economics work better than just storing it. But again, scale is the question. Can these processes be scaled to make a meaningful dent in global emissions? That's uncertain. The pitch is compelling. Livestock farming produces about 15% of global greenhouse gas emissions. They've raised hundreds of millions and gone public or sold to larger companies. But adoption has been slower than hoped. Many people tried plant-based meat once and didn't like it enough to switch permanently. Sales growth has slowed. Stock prices have fallen. Beyond Meat stock is down over 80% from its peak. But investors haven't given up on the sector. They've just shifted focus to cultivated meat. This is meat grown from animal cells in bio. It's real meat, genetically identical to conventional meat. But no animals are slaughtered. In 2023, Upside Foods got USDA approval to sell cultivated chicken in the United States. This is a huge milestone, but the economics are still terrible. Cultivated meat currently costs hundreds of dollars per pound to produce. That requires massive scaling of bioreactor production and reducing input costs. Will that happen? Maybe. Some experts think it's achievable within a decade. Others are skeptical. There's also precision fermentation. Instead of growing meat cells, you engineer microorganisms to produce proteins that are identical to those in animal products. You can make milk protein this way, or egg protein, or collagen. Perfect Day is making ice cream from fermented milk protein. Battery technology is another huge area. Tesla's success proved that electric vehicles are viable. There are others working on lithium-sulfur baterías, sodium-ion baterías, zinc-air baterías, and various other Each has theoretical advantages. But commercializing new battery technology is incredibly difficult. You need to prove it works reliably for thousands of charge cycles. You need to manufacture it at scale with consistent quality, and you need to compete with lithium-ion batteries that have had decades of optimization and massive manufacturing infrastructure. Most battery startups will fail, but the ones that succeed could be worth tens of billions, so investors keep funding them. Grid-scale energy storage is related. As more electricity comes from solar and wind, which are intermittent, we need ways to store energy. Batteries are one option, but there are others. Compressed air storage, pumped hydro, thermal storage, flow batteries, gravity storage. There's a company called Energy Volt that stores energy by lifting and lowering massive concrete blocks. When electricity is cheap and abundant, motors lift blocks. When electricity is needed, the blocks are lowered and the potential energy generates electricity. It sounds absurd, but it's real, and they've built demonstration facilities. They went public at a multi-billion-dollar valuation. Their stock has since crashed, but they're still building projects. Flow batteries are another approach. Companies like ESS and Form Energy are developing batteries that store energy in liquid electrolytes in large tanks. These can potentially be cheaper for long-duration storage than lithium-ion baterías, but they're not yet commercially proven at large scale. Investors are betting that grid storage is going to be a massive market. As renewable energy grows, storage becomes essential. The global grid storage market could be worth hundreds of billions within a decade. Whoever dominates it will make enormous money, so startups are getting funded despite uncertainty about which technology will win. Nuclear technology is getting renewed attention. Traditional nuclear power fell out of favor after accidents like 3 Mile Island, Chernobyl, and Fukushima. But climate change has revived interest because nuclear is carbon-free and provides reliable baseload power. Startups are developing new reactor designs. Small modular reactors, or SMRs, are smaller than traditional reactors. They're built in factories and shipped to sites. They've gotten regulatory approval in the US and have orders for reactors. But projects have been delayed and gone over budget. Others are working on even more advanced designs. Molten salt reactors, fast reactors, fusion reactors. Nuclear fusion is the holy grail. If we could achieve controlled fusion, it would provide nearly unlimited clean energy. Dozens of startups are working on it. Commonwealth Fusion Systems, backed by Bill Gates and others, has raised nearly $2 billion. They're building a demonstration reactor. This doesn't mean commercial fusion is near, but it proves fusion is physically possible. Investors are betting that with enough money and innovation, commercial fusion could happen within 10 to 20 years. Green hydrogen is another hot sector. Hydrogen can be produced by splitting water using electricity. If that electricity comes from renewables, you have clean hydrogen that can be used as fuel or chemical feedstock. It could replace natural gas in industrial processes, or power ships, and planes, or be converted to synthetic fuels. Companies are raising money to build electrolyzers that produce hydrogen efficiently. Others are developing fuel cells and infrastructure. The challenge is cost. Let's talk about vertical farming and agricultural technology. Apply fertilizer only when needed. Identify diseased plants early. Harvest more efficiently. This reduces waste and emissions. Companies developing these technologies are getting funded. Indigo Agriculture raised over $1 billion to help farmers adopt regenerative practices that sequester carbon in soil. But the company has struggled. Many farmers are slow to adopt new practices. Returns haven't materialized. The company has had layoffs and pivoted multiple times. This illustrates a challenge. Even if technology works, getting it adopted at scale is hard. Now, let's talk about the investors driving this gold rush. Bill Gates is perhaps the most prominent through breakthrough energy ventures. He's invested in dozens of climate startups. He focuses on technologies that can achieve massive scale. He's written a book, How to Avoid a Climate Disaster, outlining his thinking. He believes innovation is essential, that we need breakthrough technologies, not just incremental improvements. His investments reflect this. He's funding nuclear fusion, green steel, sustainable aviation fuel, lab-grown meat, and other ambitious technologies. Some will fail, but he's betting that a few massive successes will offset the failures. Jeff Bezos, through the Bezos Earth Fund, is taking a different approach. He's giving away $10 billion primarily to conservation and social programs. But he's also investing in climate tech. His fund has backed companies working on sustainable protein, renewable energy, and other areas. Like Gates, Bezos sees climate as both a moral imperative and a business opportunity. And he has the wealth to make massive bets. Beyond individual billionaires, there are specialized climate venture capital firms. Breakthrough Energy Ventures is one. Lower Carbon Capital, run by Chris and Crystal Sacca, is another. This approach is controversial when applied to climate, because unlike software, climate technologies They require building physical infrastructure. The VC model of rapid growth and quick exits might not translate well. Some critics argue that climate needs more patient capital, long-term investments that accept lower returns but have higher probability of success. Others argue that VC money, despite its flaws, is accelerating innovation in ways that traditional energy companies and governments weren't. There's also a lot of corporate venture activity. Oil companies like BP, Shell, and Chevron have climate investment arms. They're funding carbon capture, hydrogen, and other technologies, partly to find growth opportunities beyond fossil fuels, partly to greenwash their image. Automakers are investing in battery and charging companies. Utilities are funding grid technology startups. Industrial companies are backing sustainable materials and manufacturing technologies. This corporate money is strategic. They're investing to gain access to technologies they might need or to acquire potential competitors. Now let's talk about the hype and fraud risks. Whenever there's a gold rush, there are scammers. Climate tech is no exception. Some companies are making claims that don't hold up to scrutiny, exaggerating their technology's capabilities, misrepresenting their progress, or outright lying. There was a company called Nikola that claimed to have revolutionary hydrogen truck technology. They released a video of their truck driving. It turned out the truck was rolling downhill with no power. The founder was later charged with fraud. There have been other scandals. Battery companies claiming breakthrough technology that doesn't work. Optimism is rewarded. Realistic caution can mean not getting funded. So there's pressure to hype, even if unintentionally. Let's talk about what actually needs to happen for a climate tech to succeed. First, technology needs to work at scale. Lab demonstrations are different from commercial production. Something that works in a small pilot might not be economical at industrial scale. Many climate technologies face this challenge. They work technically, but when you try to scale up, costs are too high or reliability issues emerge. Overcoming this requires massive capital investment and years of engineering work. Many startups underestimate this. Second, policy support is often necessary. Carbon pricing, subsidies for clean technologies, regulations that disadvantage fossil fuels. Without supportive policy, clean technologies struggle to compete with entrenched alternatives. The Inflation Reduction Act in the US provided hundreds of billions in climate subsidies. This has supercharged investment in American climate tech. Europe has similar policies, but in many countries, policy support is weak or non-existent. This limits market potential for climate startups. Third, incumbents need to be disrupted or converted. Fossil fuel companies, traditional automakers, industrial manufacturers, these are massive, powerful entities with every incentive to resist change. Some are genuinely transitioning, others are engaging in greenwashing while continuing business as usual. Climate startups have to either compete directly, which is hard, or find ways to work with partnership models where startups provide technology and incumbents provide manufacturing and distribution can work, but requires alignment of interests. Fourth, consumers and businesses need to adopt new technologies. Even if a clean technology is available and affordable, people have to choose it. Electric vehicles are now competitive with gas cars in many markets, but adoption varies widely. In Norway, over 80% of new car sales are electric. In the US, it's about 7%. In many countries, it's below 1%. Cultural factors, infrastructure, and policy all affect adoption. Climate tech companies can't control all of this, but it determines whether they succeed. Now let's look at some success stories to understand what works. Tesla is the obvious one. They proved electric vehicles could be desirable, not just economical. They built out charging infrastructure. They vertically integrated to control quality and costs. And they benefited from founder vision and leadership that persisted through near bankruptcy. A decade earlier, they might have failed. Rørsted is a less famous but equally impressive example. They were a Danish oil and gas company. They made a strategic decision to completely exit fossil fuels and become a renewable energy company. They are now one of the world's largest offshore wind developers. Their stock has done well. They've proven that energy companies can transition, but it required bold leadership and supportive policy in Denmark. Northvolt is a European battery company that's attracted billions in investment and orders from automakers. They're building gigafactories to produce batteries in Europe, reducing dependence on Asian suppliers. They haven't proven themselves yet, but they're well-funded and have the partnerships they need to succeed. If they execute, they could become a European champion in battery production. Form Energy is developing iron-air batteries for long-duration storage. They've raised over $1 billion. They're still but they're a good example of a well-managed climate tech company with realistic timelines and strong technical foundations. These success stories share common elements: compelling technology that addresses a real need, strong leadership, patient capital willing to fund through development and scaling, partnership with customers, and often supportive policy environments. Startups that have these elements have a shot at success. Those that don't usually fail. For some sectors, we're already seeing results. Electric vehicles 1. Tesla and other EV makers have proven that technology works and consumers want it. The question now is just how fast the transition happens. 4 other sectors, we're 5 to 10 years from clarity. Battery technology, alternative proteins, carbon capture. These are still in development and early commercialization. We'll know by 2030 whether they've achieved scale. For fusion and some other long-term bets, it might be 2040 or beyond before we know if they'll work commercially. This creates challenges for investors. If you invest in a fusion startup today, you might wait 20 years for an exit. That's much longer than typical VC. So climate tech is attracting a different kind of investor. People who are patient or who believe so strongly in the mission that they are willing to accept longer timelines and higher risk. This might actually be healthy. It could create less pressure for premature exits and more focus on actually solving problems rather than flipping companies quickly. Let me talk about what happens when the bubble pops, because there will be a correction. There always is after a gold rush. Valuations are inflated for many climate startups. They're based on hope and potential, not current revenues. When reality sets in, when it becomes clear which companies are succeeding and which are failing, there will be a reckoning. Some companies will go bankrupt. Others will see valuations slashed. Investors will lose money, possibly billions of dollars. This happened in Clean Tech 1.0 in the mid-2000s. There was a boom in solar and biofuel investments, then a bust. Many companies failed. Investors lost big, but the bust doesn't mean the sector is dead. After the Clean Tech 1.0 bust, solar technology continued improving. Costs fell, and now solar is the cheapest electricity source in many places. The companies from the first wave mostly failed, but the technology succeeded. Second-generation companies built on the lessons learned. Something similar will probably happen with current climate tech. And eventually, the successful technologies will scale. The risk is that a bust discourages investment. If investors lose money, they become cautious. Funding dries up. This could slow climate technology development exactly when we need it to accelerate. To prevent this, there needs to be patient capital and realistic expectations. Investors need to understand that climate tech is long-term and risky, but necessary, and returns might come from societal value as much as financial returns.